Hello, everyone. This is Jack Keller, Vice President and Senior Consultant for CBIZ Retirement Plan Services. We're excited to give today's presentation on 403B operational compliance. Before we begin, I'd like to cover a few housekeeping items. At the bottom of your audience console are multiple application icons for you to use during the program today. I'd like to take a minute to highlight a few of the key icons for you. If you have any questions during the webcast, please submit your question via the question box. We'll try to answer all questions during the webcast today, but if a fuller answer is needed or we run out of time, it will be answered later via email. There's also an icon to assist with your viewing preferences. Accordingly, please note that you can expand your slide area by clicking on the maximize icon on the top right of the slide area, or by dragging the bottom right corner of the slide area. If you have any technical difficulty, please click on the help icon. It has a question mark and provides information regarding common technical issues. A copy of today's slide deck is available on the resource list icon that looks like a folder at the bottom of your screen. This program has been approved for Colorado, Illinois, Iowa, Missouri, Nebraska, Tennessee, Texas, and Wisconsin continuing legal education credits. To report your hours in Illinois, Nebraska, Tennessee, or Texas, click on the CLE widget at the bottom of your screen and complete the questions. And lastly, a recording of the webcast will be available tomorrow for watching and sharing. Once available, a link to the recording will be emailed to you along with a certificate of attendance. Joining me today is Patty Stamm and Michael Tableson. We have been able to tap into really our national experts at CBIZ and Husch for this webinar. Patty is a senior retirement compliance consultant at CBIZ Retirement Plan Services. She's out of our Phoenix office. She's an enrolled retirement plan agent, as well as a credentialed member of the American Society of Pension Professionals and Actuaries, holding the Qualified Pension Administrator and Qualified 401k Administration designations. Michael is a partner with Husch Blackwell out of the Milwaukee office. Michael has significant experience advising employers, retirement plan fiduciaries, insurers, and plan administrators at the local, regional, national, and international levels. His work in both law firm and accounting firm environments gives him a unique perspective on concerns of clients in the for-profit, not-for-profit, and governmental sectors. With that, Michael and Patty, take it away.
Excellent. Thank you very much, John. And good morning to everybody. And I'm going to run us right into the slides. What I'm going to do is I'm going to set the table by providing a framework and the background for Emily and I to discuss common 403B plan compliance issues. And I'm going to take us in a Wayback Machine to 1958 to start off very briefly when 403B was enacted. Just for some context here, and that there were preliminary regulations issued by the Treasury Department in 1964, which were still in place when I started working in 403B compliance nationally at Deloitte in the early 90s. And I have to say that these arrangements were generally not perceived as plans. It just wasn't. And it was a very difficult exercise in terms of addressing this hodgepodge of rules at that point, where in the private sector, the rules were coming together and things were becoming kind of more normalized and systematic in the private sector for 401k plans. We got proposed regulations in 2004, and then as we come onto the slides, you'll see here, things became a lot firmer as we got these a lot clearer with final 403B regulations in July of 2007. We got guidelines from the IRS on written plan document requirements, which should have been in place, and I'm sure all of you have had these in place on or before December of 2009, and obviously we're living in an environment where we're now seeing more IRS scrutiny. And then what I'll do is I will take you into this next slide if it comes along. There we go. Got it. All right. The plan document. What I want to mention about that is the plan document has to require or has to satisfy all the Internal Revenue Code requirements and, if applicable, ERISA requirements, and have all material terms for operation. I'll mention briefly that there are pre-approved plans now. The IRS has opened up a program for filing for those. Those are still in process. And also we've had recent guidance this year laying out by administrative fiat a remedial amendment period. What does that mean? That's the period during which you can go back retroactively and fix your plans to satisfy legal requirements. In the world of the private sector, again, 401k plans, those time frames are laid out by statute and regulation. Here, since those things aren't in place, the IRS basically needed to invent one, and they've given us all a bit of time here until March of 2020. And then again, setting the table for this conversation about these compliance issues, what we're going to be working under here is an IRS framework called the Employee Plan Compliance Resolution System, EPCRS, or if you prefer, EPCRS. What it does is basically lay out a set of correction principles that fundamentally require that what you do is put the plan back in the position it should have been if it had been properly administered or written, which then takes us to the two fundamental types of errors that can come up here, which are either documentation errors. The document isn't written correctly for legal requirements or doesn't match the way the plan was administered or was intended to be administered, or operational failures. In other words, the document's correct, but for some reason the plan wasn't operated correctly. Then under EPCRS, what you have essentially for insignificant errors is self-correction, the concept of voluntary filing, voluntary correction filings, or worst case scenario, this is not the preference. If an issue comes up where the IRS has knocked on your door and said, hi, we're here to help you, and an issue comes up on exam, and what you do is settle that issue through the audit closing agreement program. I will mention that for pre-2009 issues, the only kinds of errors, basically what you're going to be doing is self-correcting for anything but legal requirements. If there are operational failures, and we'll talk about this in more detail, it's going to be a matter of self-correction. But post-08, which should be most of what we're looking at these days, what we'll be doing is looking at probably either self-correcting or filing with the Internal Revenue Service. And with that, I'll pass it off to Patty.
Thanks, Michael. Before we get started talking on the different areas where I've seen some issues, I do want to just mention that I have a couple of goals for this discussion. One is to help those of you that are coming from the for-profit world and may have a lot of experience with 401k plans, to let you know that 403B plans look very similar, but have a lot of different little quirks to them. And those little quirks that are different from 401k plans also tend to be the areas where I see problems arising. So that's number one. Just remember 403B is not the same as 401K, and we'll talk about those differences. Number two, as I do in my work, operational compliance assessments for our 403B clients, that's where I have seen a lot of these issues come up, and I see them quite frequently. So my second goal is to make sure you know you're not alone. These issues happen in almost every client that I work with, and just know you have a lot of company. It's okay. We'll get through it. I don't want anyone to panic as we talk about some of these things, and you're thinking back to what's happening in your office and realizing you may have something you need to work on. And then the third goal is let you know there's lots of resources to help you if you do come across one of these issues that we're going to discuss and you recognize it as something that's happening with your plan. Michael's going to help us with a lot of information about EPCRS and various other correction activity that might take place, and your TPA or ERISA attorney can help you with any of the things that we will talk about. So let's get started. Number one, the first issue that I want to review is eligibility considerations. So one of the first differences in a 403B plan that does not exist in a 401K is the concept of universal availability. And these are regulations within the tax code that essentially indicate that all of your employees have to be given an opportunity to make a deferral election in your 403B plan. This is required in all 403B plans, but there are some exclusions, different types of employees that can be excluded, but those are limited to the exclusions referenced in the tax code. So some of the more common ones are employees who are eligible to make deferrals in a different 403B plan or 401K plan or governmental 457 plan. That's a permitted class exclusion that we can have in the 403B plan. Non-resident aliens can also be excluded from making deferral contributions. Another very common one I see in the higher education environment is the exclusion for students whose employment at the college or university is incidental to their education. The only issue that I have seen come up with this, well, I won't say only, there's a couple of them. One, the practice of excluding the students, but the plan document didn't actually say that they would be excluded. And then the other one is the practice of excluding students from another university. If you're in an area where there's a number of schools in the area, you might be hiring students from other schools. The only students that can be excluded from your 403B plan are those that are actually enrolled in your own organization, not the students from other schools in the area. I have actually seen that come up. It does happen. One of those quirks to be aware of. Then the biggest issue that I see, and this is a really tricky requirement in the tax code, is that the regulations indicate you can exclude employees who normally work fewer than 20 hours per week. And that's the language typically seen in your plan document, that phrase right there, those who normally work fewer than 20 hours per week. The problem that occurs there is that is not the full regulation. The regulation goes on to indicate that if any of those employees that you were excluding in this class do subsequently work 1,000 hours or more in a plan year or a calendar year, depending on what your plan document says, those individuals who are working 1,000 hours or more are no longer a part of this class that's identified as normally working fewer than 20 hours per week. If someone's working 20 hours a week, they're actually working consistently 52 weeks. They're working more than 1,000 hours in a year, and so you have to then identify them and allow them to make a deferral election in the plan. And that's one of those provisions that really trips people up, just because the plan documents tend to put just the shortened provision in there and not the full tax regulation as it's actually written. So that's an area that we see with a lot of problems. Michael talked about the plan document, and one of the things I'm going to refer back to on a regular basis with any of these issues that we discuss is what your plan document says. Your plan document is your roadmap to how you will be offering benefits to your employees. I kind of frame it as a contract with the school, the employees, and the government in terms of their oversight of the benefits that you're offering. And in this contract or plan document that we're writing, you're indicating you're going to provide certain employees who meet certain requirements with a certain type of benefits, and how those benefits will be calculated, how they'll be distributed, all of that. And so we have to follow what our plan document says. That's our roadmap that we are required to follow unless we make changes to it within the appropriate time frame and in the appropriate way. So talking specifically about our next eligibility consideration, if your plan document allows for certain classes of employees to be excluded from employer contributions, then you can do so in practice. But if in practice you are excluding certain employees and not providing them with an employer contribution, but your plan document doesn't indicate that they'll be excluded, you do have an operational failure. This is where I also refer to this sometimes as drift. A plan document was written several years ago. There's been turnover in the benefits department or the payroll department, or it's been described differently from one person to the next as to who's allowed to be in the plan, and we move away from maybe what was originally operated appropriately to internally we've got some different practices taking place, and we need to be mindful of that and make sure that both our plan document and our procedures internally are consistent with each other. And so this is where I see classes of employees being excluded from a contribution, but the plan document doesn't indicate that they will be excluded, or the opposite, employees receiving contributions when the plan document clearly indicates they are not to be included in the plan for an employer contribution, and we need to have some correction take place. The last eligibility issue that I find is the plan document. Again, you'll hear that, sorry for being repetitive, but that will be the case through all of these slides. Plan document maybe requires a certain number of hours to be worked in order to be eligible for an employer contribution. But the employer doesn't track hours that are worked, especially in the higher education environment with faculty numbers. This is very common. So you need to sit down and decide how are we going to make our plan requirements consistent with what our practices allow us. Are we going to use some sort of an elapsed time method of counting service to become eligible? Are we going to use an equivalency method of working 1 hour within a week will be equivalent to working 45 or more, I think is the IRS requirement? Or are we going to set down a consistent policy that a certain number of classes taught, committees served on will all be equivalent to a certain number of hours, and we're going to be consistent in applying that to our faculty in determining how many hours they have been expected to work. So that's where I see a lot of issues specifically in the higher education environment come up a lot. Michael, any thoughts on corrective activity for any of those issues?
Yeah, certainly. In general, if we've effectively over-included people, then what's going to happen is the plan's going to have to distribute the amount that shouldn't be in the plan, right, plus earnings. If you've under-included people, what you're going to need to do, again, following these kind of fundamental correction principles of EPCRS, you have to get those amounts into the plan, make up for earnings. Now, in terms of this IRS framework of EPCRS, the kind of decision tree is going to be, is it really an operational failure that you just need to fix the operation? And kind of to this concept of drift that Patty was talking about, or is this a plan document failure where you need to get that plan to comport with the operation? If it's a plan document failure, it's going to have to be filed with the IRS. And then the other kind of decision point is going to be, is it significant versus insignificant? If it's not a documentation failure, and if it's significant, you do need to file it. Of course, you can always file with the IRS. It's basically like an insurance policy if you're going to ask them about it. You know, that's how that's going to go. The only other point I'm going to make is keeping in mind as you work your way through this decision tree, if it's a plan that's subject to ERISA, as you're thinking about how you're going to correct or change documentation, you're going to have to keep in mind to also this model that she's set up of this kind of three-party contract. You know, participants going to have the ability to turn to either courts or the Department of Labor if they feel like they're getting the short end of the deal. And it's going to definitely color how you look at making your corrections.
Okay. Thank you, Michael. So our next consideration is with the compensation that's used to calculate benefits for employees. Issues that I see frequently often relate to excluded components of compensation. The IRS has some pre-approved definitions of compensation that they allow employers to use in their plan. You're not required to use those, what are called safe harbor definitions. So you can identify the definition of compensation to exclude certain pieces that maybe are specific to your organization, such as excluding bonuses, summer pay, you know, anything specific that your institution just really has determined should not be a part of the benefits package when determining how much of a contribution will be made for an individual. If you choose to exclude certain components that the IRS hasn't already given their blessing on, then you have some things that you need to be aware of. Number one, here's my broken record of make sure that your plan document actually identifies that you'll be excluding those components. Because if you're using one of the blanket definitions, then it won't provide for a specific piece of compensation that you might think is not appropriate to be included in this calculation. So we have to have consistency, again, between practice and plan document. And then further, there's some potential for non-discrimination testing that needs to be performed in order to confirm that that definition that you've decided to use is not discriminating in favor of your highly paid employees. And that needs to be done on an annual basis and documented for the plan's record to show that you're operating the plan in accordance with all of the regulations. Another issue that I see, not quite as common, but it does come up, is relating to pay period issues, where the plan document will indicate that compensation from date of plan entry, that's the date an employee actually becomes eligible for a certain contribution, compensation paid prior to that date is not to be taken into consideration when calculating the contribution. And I've actually seen this issue go both ways, where the compensation, the Excel worksheets or the benefit software that was being used did not get set up appropriately to exclude certain compensation. I've also seen it go the other way, where the it's being included in the calculation. It should not be, but I've seen it go both directions in practice. Again, just the need here is to make sure, what does our plan document say we're doing? Are our systems set up? If we're doing it in Excel, did we write the right formulas? Are we tracking those components in our payroll system to be able to identify them appropriately? Those are the questions that need to be asked for this particular issue. Michael?
Actually, Patty, I think, again, for these even for the next slide as well, as we come up here, it's that same basic paradigm of looking at this and trying to figure out if this is just something we can self-correct or have to take to the IRS. And again, with all of these things, I'll throw in that other law out there hanging around, this Employee Retirement Income Security Act of 1974, that basically says you have to do what you promised to do, right? So it just, focus your attention on how it is you're likely to have to approach any corrections.
Okay. And next we have deferral considerations. For the most part, I see the deferral activity handled appropriately. Again, if your plan if you want to allow for Roth contributions, your plan's got to say that. You've got to get that in your plan document first before you offer it. Those types of things seem to be straightforward. Where I see issues potentially arising sometimes, the special organization 403B catch-up contributions. Now, this is not the same as the age 50 catch-up contribution, which is also available in the 403B plan. You can offer both. Only certain organizations can offer the special 403B catch-ups, although educational organizations are one of them, which is why this is an appropriate discussion for our group. What is frequently not known by the employer is that there is a lifetime limit on the special organization 403B catch-up contributions, and there's a fairly complex calculation of how much can actually be contributed under this provision. So the recommendation, of course, is number one, know what those rules are. Make sure you have the data to be able to calculate it for your employees that are making these types of contributions. There is a coordination requirement with the age 50 catch-up contribution, and you need to be aware of that as well. And also know those lifetime limits. It's actually only $15,000 is the lifetime limit, assuming the individual is able to maximize the full catch-up contribution availability. So that's going to, they can do $3,000 a year with a limit of $15,000. So you have to really be watching those contributions to make sure that you don't exceed those limits. Michael, I know you said a lot of these are in the same sort of situation as far as correction activity. Any specific thoughts for the deferral issues? I know a lot of that we can correct right within the tax code. It provides us some options, but any thoughts for the EPCRS?
Nothing in particular. Again, these are legal limits, and actually this is going to apply as we come into some of these other testing requirements. These aren't going to be typically design issues, right?
Right.
These are going to be
agreed.
So right. So fix it. Make a determination of whether or not it's significant. Get it fixed. With all of these things, better to find it and be proactive. I know some people don't like that word, but get ahead of this. Get things mitigated. Even if it does come up on exam later, if you don't file, it's always going to work in your favor if you can find this and fix it.
Agreed. Definitely good advice.
Thank you.
So some employer contribution topics to consider. The deferral contribution to a 403B plan is not subject to testing. That's one of those differences between a 403B and a 401K. 401K, you're always required to test the deferrals unless you're making safe harbor contributions. The 403B deferral is never subject to any testing. However, any employer contributions that are being made to the plan, if it's a match on the deferral or it's a straight percentage of pay, maybe based on a tiers with years of service at the institution and so forth, that's all subject to non-discrimination testing on an annual basis. And the purpose of that testing is, again, to mathematically prove within the limitations that the IRS sets for us that those contributions are not being made in a discriminatory way in which highly compensated employees are receiving a significantly greater benefit than the rank and file employees. So we have this all mapped out for us within the tax code, tells us exactly how it needs to be tested. There can be differences between the two groups. in terms of the contributions being made between what the highly compensated group is receiving and what the non-highly compensated group is receiving. But there's a limit to how much of a difference there can be. Again, all laid out in the tax code for us. So we know exactly how to test it, but you do need to test it each year and make sure that the formulas that you're using, the benefit structure you've designed for your institution is staying within these limits, and you are not providing what the IRS would consider to be a discriminatory contribution to your employees. So again, if this is not occurring for your plan, for your 403B plan, you want to reach out to your advisors, ask why. There are some design features that you can implement within your plan that would meet safe harbor considerations that the IRS has provided for us. But if you don't meet any of those safe harbor provisions already, then you need to make sure that this testing is being done. And one of the reasons is also you want to have that report that does show that your benefits that you're providing are not discriminating in favor of the highly compensated employees. And if your plan is selected by for audit by the IRS, this will be on their checklist. This will be a document that they will want to see. Did you perform all of the testing, and did you pass all the testing? So Michael, I don't know if you have any thoughts on that. It's not really necessarily a correction activity. This could lead to correction activity, but
there are certain kind of preset methods or approaches to correction of either bringing certain non-highly compensated employees up or the highlies down, or different approaches. The only other thing I did want to mention in this context, Patty, is just that there are a different set of standards if the organization is a church or governmental organization, and we might have some universities here that might fall into those categories.
Yes, those two types of plans, thank you for remembering that. Those two types of plans are subject to different rules. These particular non-discrimination testing requirements do not necessarily apply there, so you want to check based on your plan type. The church plans do in fact have some testing requirements, so you'd want to explore that very closely with your advisors and make sure you're clear. The governmental plans, that's a whole different set of rules, so thank you for mentioning that.
Right, and there are different kinds of church plans there can be church plans that elect into ERISA coverage that's not available for governmental plans. So to Patty's point, just something to make sure you follow up on. And then there might be some changing standards or different views of what actually constitutes a church plan these days. So.
Correct. That's become a gray area these days and still working its way through the court system, hopefully with an eventual answer on that particular question. So continuing the discussion on employer contribution issues, this really goes back to everything that I mentioned previously, the plan document outlining how you've agreed to provide benefits, the potential for the drift or miscommunication, whatever the case may be. But I see this frequently, again, where the formula that's in the plan document that says this is how we will calculate benefits. These are the percentages we'll provide, or these are the years of service that will count towards different levels of contribution that you might be eligible for. That all has to be identified very clearly in your plan document, and then you need to look at your internal practices and say, are we actually doing our calculation consistent? If your plan document isn't in line with your practices, as Michael has said, you need to ask yourself which of these is out of alignment, where are we making our corrections? You can change the formula in your plan document. It's not that you're locked into it once you put it into your plan, but you need to make changes on a timely basis. When you decide you want to provide a different level of benefit, you need to put that in your plan document prior to actually implementing those changes internally, because you also have to advise your employees of the changes that you're making to the plan. So there's a timing issue here as well when you start talking about we want to change how we're providing these benefits. Just make sure that you're doing it in a timely manner. Plan document first, practice second. So As I mentioned here, a couple different things that I see, these all roll into that same sort of conversation. Changes over time, not incorporated into the document, or sometimes it's changes in the employment status of certain employees. They're changing positions. They become eligible for a contribution that they weren't previously eligible for, or vice versa, and that hasn't been incorporated into the practices, noting that someone is now either eligible for something they weren't previously, or they're no longer eligible for something they had been receiving. And then it's not uncommon for the plan document to indicate that even though you have an eligibility requirement initially to become a participant that's eligible to receive employer contributions, you can have a second requirement that says in order to receive each year's contribution, you have to work a certain number of hours, or you have to be employed on a certain date, typically the last day of the plan year. That's not unusual. That's all intended to promote longevity with the organization. But you need to make sure that you're able to abide by those conditions that you put in your plan document when you're calculating and depositing your contribution. So an example that I run into quite frequently, also in 401k plans actually, is in order to receive a matching contribution, an employee has to work 1,000 hours in that particular plan year. But the contribution is being deposited each pay period, starting with the first pay period in January. Well, it's impossible for that individual to have worked 1,000 hours in the first week or two of January, so clearly they've not met the requirement to work 1,000 hours, but the employer's already putting money into their account for a match they have not yet earned. So that inconsistency has to be resolved with either we're going to remove the requirement that they work 1,000 hours, or we're going to stop depositing the match every pay period, and we will do it once at the end of the year when we can determine which of our employees met that subsequent requirement and are eligible for the contribution. So whatever works for your organization is fine. You just have to make it consistent again. Michael, your thoughts?
I'm right there with you, Patty. I think you got it.
All right. Sorry, I didn't mean to steal your thunder there. Kind of roll into the conversation on the topic.
Yep, all good.
Okay, employer contribution considerations continuing. Just to make you aware, again, I see this where internal systems, benefit software, payroll software, or even the Excel worksheet that you might be using isn't updated for the IRS limits on contributions. And this actually also goes to compensation. So a lot of these limits for how much compensation can be recognized and how much of a contribution can be made for employees, they're subject to cost of living adjustments annually. The IRS puts out their cost of living adjustments in October, towards the end of October every year. The limits don't change every year because they have to increase by a set dollar amount before a change is made, so that they're not just increasing by $1 or $2 each year. But they do frequently change, enough that you really do need to look at those limits each and every year to prepare yourself for the coming year. The compensation level, the amount of compensation that can be recognized for your highly paid individuals, that changes almost every year. The 402G limit is the limit that defines how much of a deferral can be made to the plan each year on a calendar year basis. These limits are typically all calendar year basis, on a calendar year basis. So you need to be looking at those, be familiar with them, check with your payroll vendor if you're using a third-party software, make sure they've got it incorporated appropriately so that your systems are calculating contributions appropriately and you're not violating any of these limits. Michael, anything on this one?
Well, again, just following on the EPCRS guidelines, looking at operational failures in this regard, probably typically what you're going to find you're going to have to do is make refunds of excess deferrals plus earnings, issue 1099-Rs. One of the little sing-songs I've used for this, and it also comes up in the context of participant distributions that you're going to talk about in a bit, is this kind of, again, same song, too little, too late, too much, too soon. If you've done any of those things, you put in too much, you put in too little, you're paying out amounts too late, you're paying them out too soon, you probably have a failure you need to correct.
Right. One of the other things that, just to dive a tiny little bit deeper in this issue of the compensation limits, I do see that this causes problems when the contribution, especially in a matching contribution situation, where there's a limit on how much will be matched. So that's a percentage of pay. And for those that are making compensation in excess of the amount the IRS allows us to recognize, if your payroll system doesn't shut off that calculation when that person has met that limit in terms of the compensation that they've earned, that's really going to skew your matching contribution, and you're going to be providing an inappropriate match to that individual in excess of what your plan document allows them to receive. So that particular issue, I know in EPCRS there's a specific section that provides for guidance for failure to, use the compensation limit. So there's options for you to correct, but I do see that one come up, especially in the match as a percentage of compensation.
Yeah, Patty, and I suppose I should mention, just to be completely clear, as we're talking about all the correction and, IRS guidance and this correction program, what's the point? And the point is to maintain the tax status of the arrangement. And in particular, when we're talking about, eligible employers here that are non-profit, they're not, in tax exempt, they're not taking tax deductions. So really what you're doing here is protecting your employee participants and their beneficiaries so that they get an appropriate tax deferral. Right, absolutely. And maintaining the tax qualified status of the plan. Correct. In operating the plan appropriately. So it is right. It is protecting the plan as well as the individual participants, absolutely. Correct. Because you don't want that to somehow become taxable in and of itself. And in fact, right. If you don't come in and file voluntarily or fix in accordance with self-correction and do that appropriately, and the IRS finds it, typically an employer is going to make the same corrections we're talking about, right? But they're not just going to pay a set fee to file this with the IRS and get their approval. You're now going to be settling this under the closing agreement based on, an amount that's going to be done in the context of what the IRS would have collected had it disqualified the plan, had it removed the exempt status from the plan, and hence taxed both the plan and the individuals. Right, which we definitely want to avoid, for sure. Okay. Well, the IRS doesn't collect any less than it would have, let me tell you. They'll collect more. Yes. Yeah. I think one final employer contribution consideration that I have come across, it's not as common, but especially in this particular environment, the higher education environment is where I see it happening, so I want to be sure to touch on it briefly. I have seen a number of plans that have a mandatory employee contribution. Now, this is different than a 403B deferral because the deferral is the election being made to by the employee. They are electing if they want to put any of their compensation into their retirement plan, and that is under a different tax code section. It's got a different characteristic to it. That is not a mandatory employee contribution. But it's not unusual to see a mandatory employee contribution in higher education plans, and it also typically has an employer contribution being made in conjunction with it at the same time. That's also usually the case. Both the employee and the employer are putting in a set amount as defined in the plan document for the retirement benefits. What's often unacknowledged, if that's the correct word, is that is considered under IRS regulations as an employer contribution.
both the piece the employee is putting in from their pay as well as the piece the employer is putting in, because the employee has no say in whether or not this amount will be deducted from their pay. So that employee contribution and the employer contribution are both subject to very specific non-discrimination testing on an annual basis. And I often see the word matching contribution applied to the piece that the employer is putting in. A lot of times it is the same percentage that the employee is putting in. I just want to mention, don't confuse that with your typical match on an elective deferral. It has different characteristics. The word that I see often used as match, it makes it very confusing. It is not the standard discretionary match if an employee decides to put in their own money. These are both mandatory contributions that the plan document is requiring, and so they're subject to very specific testing each year, again, proving that it is not discriminatory in favor of the highly paid employees. Michael, I don't know if you've had any experience with this type of contribution in any
I have primarily, I usually see these. I rarely see these in anything other than a governmental plan or a university connected to a government these days. I don't see them as often. I don't know which environment you're running into them.
I have seen them in the university environment, in the not-for-profit, in the private universities. And again, it's not frequent, but it's come up more than once. And so to me, that makes it something just to throw out there so that folks that might have this in their plan think about it and, maybe say, hey, we might need to be looking at something else there. So not a standard provision, but I've seen it a couple of times now.
I've actually removed this from a couple of plans in the last few.
All right. Participant loan considerations. This is not necessarily an area where I see a lot of non-compliance specifically, but for me this goes back to those little quirks, the differences between 403B and 401K plans, so I thought I would just mention it briefly. There is something unique. I'll say it's unique to 403B plans because these days 401K plans rarely use annuity products as their investment options. It's typically your standard mutual funds and that's all. When a 403B plan, it's very common. In fact, that's part of how they were established is to use annuity products as the investment vehicles for the plan. When there is an annuity in place, that insurance company can operate as far as participant loans in a little bit different manner than when the plan is just using custodial accounts, which is, again, going back to just our mutual funds. In the mutual fund environment, when a participant requests a loan against their account, they're usually paid funds directly from their account. Their mutual funds are liquidated and they receive a check for that amount. So now their account balance is made up of a portion of their remaining mutual funds plus the debt or receivable of the participant loan that they are repaying to their account, and that's how their account balance is made up. In the annuity environment, because of the restrictions on liquidating funds within the annuity, paying out funds within the annuity, it is not unusual for those annuity vendors to make a participant loan from funds in their own general assets. So you would not see a liquidation of the participant's holdings. They are being granted a loan directly from the insurance company. However, their plan account is used as security for that loan. Because their investments are not being sold, they retain the investment earnings on those holdings, so the interest on the loan is generally paid directly to the insurance company or investment provider, and they keep that in their general assets as income on the loan that they made to the participant. So I thought it was worth mentioning this is a difference when plan assets are actually released to the participant, as in the mutual fund situation for their loan, versus their assets are securing the loan made by the insurance company. So that's something to be aware of.
Patty,
Yes,
I think
Michael?
that's where I should jump in.
Absolutely.
And just mention, right, that there is, and obviously we had talked about this, a pending lawsuit in the Southern District of New York against TIAA. Now that case is still pending class certification, but the class is intended, it's proposed to be made up of Washington University and all similarly situated plan sponsors. The claim, obviously this drills down to particular participants. The claim is an ERISA claim that there's a conflict of interest, and an ERISA violation in this paradigm that you just described, that's used by TIAA and other similarly situated providers, if you will, platforms, where the claim is that by retaining the difference between the interest on the participant loan and the earnings on the account, and in this case, it's an interest rate on the loans, in the 4% range, and kind of a standard earnings rate in the accounts, let's just say in a general account of 3%, that retaining those earnings violates ERISA, and the claim here, they're purporting, the plaintiffs in this, putative class, that the amount that TIAA is retaining impermissibly is on the order of magnitude of $50 million a year. So this is a very significant case. Needless to say, TIAA is disputing pretty much every part of this claim.
And I think it will be interesting to see how this is eventually resolved, because it will have implications across the 403B universe, I think, as a whole, not just those 403B plans that are with TIAA. So we'll have to see where this goes, and if out of the court case, Congress, gives us some new regulations on how these loans will be handled. So I think ultimately it could have an impact broader than just TIAA, because other institutions do something similar.
Yep. Great.
The last comment I'll make quickly about the participant loan considerations is that for those 403B plans that are allowing multiple vendors, the vendors usually have within their systems, they will determine what the permitted loan amount is, just based on the assets that they're holding, when in fact the loan could be calculated based on all of the vendors' balances in total for a participant that might have funds in each vendor or multiple vendors. Gets a little tricky, but it is something to review when you're making participant loans, or you're working up your loan policy, you're working with your vendor. How do you want that activity to occur? Because the participant's entire account balance could in fact be used in the calculation of how much they can take as a loan, not just the limit of the funds that are at a particular vendor. So just sort of an FYI type of note there. And then the last point I wanted to make related to participant distribution considerations, again, in the 403B environment, because it's so common to have annuity contracts, there can be limitations on distribution activity that have nothing to do with the provisions in your plan document. So you need to be aware of what are the liquidation or distribution restrictions potentially in the investments that your plan is holding, and are those restrictions consistent with what your plan document is indicating as far as the timing of distribution to a participant, the force out of small balances, which is becoming a much more common practice in order to keep participant counts down and keep the records clean, as far as having, for the most part, your current employees in the plan as opposed to a huge list of former employees. So you need to be sure that you're fully aware of what your investment restrictions are and what you've got in your plan document indicating that you'll do in terms of those distributions. And also to know whether or not that financial institution will in fact authorize you to initiate a payout. That's not the case across the board in 403B plans because of some of the older contracts that were set up many, many years ago before all the new rules that Michael referenced at the beginning of the session. So this is more about education, educating yourself on the differences or just what do you have available in your investment options versus what your plan document says you'll do, and again, make sure that they're consistent. Michael, any thoughts on that before we wrap up?
Yep. Just a final point on all of this, as I say to all my clients, is the most important thing here to do is be intentional, look at this, pay attention to it, and document. Go ahead and identify these issues, address them, and even if you don't file it, treat it as though you were going to file it with the IRS, write it up, and have it ready just in case somebody does show up at your door and want to look.
Right, and I agree. I think the IRS and the DOL over the last several years have been very vocal about how important it is to them that plan sponsors are actually reviewing their plan. They want you to go through it, review it, make sure that you're doing everything correctly, and if you're not, that's okay. What they want to see is that you took action to correct it, and that is really important to them right now that plan sponsors are going through this activity. So again, going back to what I said at the beginning, you're not alone. There are a lot of resources for correction, and that's the action that the IRS and the DOL want to see you take, and it will go a long way towards resolving any issues if your plan does get selected, either for audit or, worst case, any sort of lawsuit by participants. That's becoming so prevalent these days, and that's a really scary thought. But the more we have documentation showing we've looked at everything, we feel we're on track, we're doing it in the best interest of our participants, the better all of that is going to go towards any lawsuit. And Michael, as the attorney, I'll let you wrap that up on the lawsuit side.
Well, on the lawsuit side, I haven't seen. Have you seen a lot of activity lately yet? I haven't here. It's not something we've talked about. Yeah.
Yes,
obviously there's this class action pending.
Yes, I think it's starting. Unfortunately, I hate.
Unless you're talking about unless you're talking about the excessive fee cases. I'm sorry.
Well, I think that's the start, and I've also seen more audit activity by the IRS. The IRS finally has resources in place to start auditing 403B plans, which did not occur previously. So I've had a number of them pop up with my clients locally here in Phoenix, so I think that's on the rise as well.
Undoubtedly a lot of activity in the IRS and scrutiny. I'm not seeing a lot of private actions yet. There have been, of course, we have a backdrop of the excessive fee cases going on.
Right, and now the participant loan case as well that's attempting to work its way through. So
correct.
That's why I say there used to be no lawsuits. Now we have several popping up, so there's just no way to predict where it's going to go, but let's take it as a warning to make sure that we have all our ducks in a row.
Oh, absolutely. And then there get to be some very complex issues of privilege, depending on exactly what you're working on, especially in the ERISA arena. So I guess the message to drive home there is just contact your ERISA attorney. And it's probably
absolutely.
Even worse. Yeah, especially even if these issues come up in conversations or committee meetings internally. As soon as you recognize any of these issues where you think there might be risk, get your ERISA counsel involved. And I did look and see, we do have a few questions that have come in, and I know Jack was going to be looking at those.
And I don't know if we
Michael.
have a whole lot of time. Jack, I'll let you take it.
Yeah. I think really what I was going to say is we've got 5 or 6 questions on here, and for the folks that asked these questions. We will just follow up with you via email specific to your question as a follow-up. One, though, that I did want to share, somebody mentioned that they got on late, just had an IRS audit. Be sure to check excluded employees, excess contributions, definition of compensation, and what is excluded. I think those were things that Patty certainly reviewed earlier in the presentation, but maybe even more impactful for the attendees on the line that somebody else shared those recommendations with their peers.
Yes, definitely.
But for the rest of you, we will follow up with our responses. Certainly appreciate everyone being on the line today. I know that this is one of the most valuable service that we can provide to our clients is really this operational compliance, and really appreciate Michael and Patty taking time out of their day to really share their expert thoughts on these issues. So thanks again, Patty and Michael.
Oh, pleasure. Thank you, Jack.
You're welcome. Thank you.
With that, thank you for joining us today for our program. We hope the information provided was helpful for you and your organization. If you've not already, please click on the survey icon at the bottom of your screen to complete our short survey. Your feedback assists us in providing quality future programs. As a reminder, this program has been approved for Colorado, Illinois, Iowa, Missouri, Nebraska, Tennessee, Texas, and Wisconsin continuing legal education credit. A recording of the webcast will be available tomorrow for watching and sharing. Once available, a link to the recording will be emailed to you along with a certificate of attendance. I believe our contact information will be in there too if anybody has additional questions. The recording will be available for 2 weeks. Again, I want to thank everybody for being on the line today, especially Michael and Patty. This concludes our webinar. Thank you very much, and everyone have a great December.
Thank you.